Welcome back to the deep dive. Before the break, we were talking about how, even little pieces of news can cause big changes in the market.
Yeah, it really shows just how sensitive those stock prices can be.
For sure.
It's a bit of a roller coaster ride, isn't it?
It is.
But even with all this unpredictability,
Yeah.
can we use those valuation methods that we talked about,
Right.
DCF and relative valuation,
Yeah.
to pinpoint like which stocks are good buys?
So that's where things get even more intricate.
Okay.
So remember when we talked about DCF as that financial time machine and relative valuation as comparing notes with your neighbor?
Yes, like crystal ball gazing versus peeking over the fence.
Exactly. Now, many investors use relative valuations, especially multiples like PE ratios,
Yeah.
to try and find those hidden gems, stocks that are undervalued by the market. So if a company has a lower PE ratio than its peers, it might seem like a steal.
So low PE, good, high PE, bad. Is that the simple rule?
I wish it were that straightforward.
Okay.
There are a lot of reasons why a company might have a low PE ratio.
Okay.
It could be facing some short-term hurdles, or perhaps investors are a little bit wary about its future prospects.
So a low PE could be a warning sign.
It's a possibility. Think of it like finding a house listed at a surprisingly low price. You would naturally wonder, what's the catch?
Yeah, is there like a leaky roof or some hidden structural damage?
Exactly.
Okay, so what should we be paying attention to when we're using multiples to compare companies?
So the key is to understand what's driving those numbers, the story behind them.
Okay.
A high PE ratio, for example, could actually be a sign that investors are very optimistic about the company's potential for growth.
Okay.
So, take those exciting tech companies.
Yeah.
They often have PE ratios that are sky high because investors are anticipating big profits down the road.
So it's not just the number itself.
Right.
We need to look at like the company's narrative.
Exactly. You have to consider the company's growth trajectory, the risks involved, its competitive landscape, and a whole range of other factors.
Right. Okay, so relative valuation involves a lot more than just glancing at a single multiple.
Absolutely.
What about DCF? Can we use that method to pick individual stocks?
So DCF can be a powerful tool,
Yeah.
but it's important to remember it relies heavily on those cash flow forecasts.
Right.
And forecasting is inherently uncertain. Predicting the future, even for companies that appear to have very stable businesses, can be a real challenge.
Yeah. It's starting to feel a bit like we're navigating through a maze here.
Yeah.
Are there any other ways that we can use these valuation methods besides like trying to predict the future or uncover these hidden bargains?
Absolutely. So remember when we talked about using an exit multiple to estimate terminal value in a DCF analysis?
Yes, that's when we use multiples from comparable companies instead of assuming a perpetual growth rate.
Right. Exactly. And this actually shows how relative valuation and DCF can work together. In fact, many professional analysts use a combination of approaches.
So they're not just choosing one method over the other.
Right.
They're using like a blended approach.
Precisely. They might primarily rely on DCF for valuation, but they'll also look at relative valuation to see how the market is pricing similar companies.
Gotcha. So like a cross-check.
Exactly, making sure that they're on the right track.
It's always good to have a second opinion.
Yeah.
Another technique I know a lot of analysts use is what's called a valuation football field.
Oh, yeah, that's a great way to visualize the range of possible valuations for a company.
Okay.
So imagine a football field
Okay.
with the 50-yard line representing the current market price of the stock.
I can picture that.
Okay, so on one end zone, you might have the lowest valuation estimate, perhaps based on a very conservative DCF scenario.
All right.
And on the other end zone, you have the highest estimate,
Okay.
maybe based on a very optimistic scenario or a high multiple from comparable companies.
So the football field kind of illustrates the spread between the most pessimistic and the most optimistic valuations.
That's right. And you can add markers for other valuation points along the field, like the average valuation from comparable companies or the average price target set by analysts.
Okay.
So it's a way of showing the range of possible outcomes and where the current market price stands within that range.
It's a helpful visual tool.
Yeah.
So even though it's really difficult to pinpoint like a single true value for a company,
Yeah,
we can at least get a sense of where it stands in the market.
exactly. And that's one of the key takeaways from this whole discussion on valuation. It's not like a precise science, but rather it's a systematic way to think about a company's worth and
Got it.
how it stacks up against others.
Okay, that's starting to make a lot more sense. Now we've covered so much ground
We have.
from like understanding the basics of what a stock is to the complexities of valuation and market efficiency.
Yeah.
It seems like the key takeaway is to approach it with humility. Do your research and be mindful of the inherent uncertainty in the market. We're back for the final part of our deep dive into stocks and the stock market. Before we took that little pause, we were talking about how stock prices really reflect those future expectations,
Right.
not just what happened in the past.
Exactly. And this leads us to kind of a pivotal question for you.
Okay.
What kind of investor do you see yourself being? Are you going to be someone who tries to actively pick stocks, or are you going to lean more towards a passive approach?
Yeah, that's the big question that's looming over us, isn't it?
Yeah.
We've learned that these stock prices are all about trying to predict the future,
Right.
that the market is remarkably efficient at processing information.
Yeah.
And even those seasoned professionals with all their fancy algorithms still have a hard time finding those hidden gem stocks.
Yeah.
So where does that leave someone who's just starting out on their investing journey?
Right. So here's where it's really important to understand the bigger picture.
Okay.
There's no one right answer, no one-size-fits-all approach.
Gotcha.
If you find the process of researching companies and dissecting financial statements and trying to outmaneuver the market,
Yeah.
if you find that thrilling and challenging,
Yeah.
then active investing might be a path worth exploring.
There's a but coming, isn't there?
But you need to approach it with a realistic mindset.
Okay.
Active investing demands a lot of time, a lot of effort,
Yeah.
and a willingness to accept that you might not always outperform the market.
Right. So it's not something to just jump into casually.
Exactly. It's not like throwing darts at a stock chart and hoping for the best.
Okay, gotcha. Well, what about that other passive investing? What does that look like?
So passive investing is about embracing the market's overall performance. So instead of trying to meticulously pick individual stocks,
Yeah.
you invest in a diversified portfolio of stocks that mirrors a broad market index like the S&P 500.
Right.
So you're basically riding the market's tide rather than trying to catch a specific wave.
Okay. What are the advantages of going that route?
So there are a couple of advantages.
Go.
First, it's remarkably cost-effective. You're not paying those hefty fees to active fund managers.
Right.
Or spending countless hours researching companies.
Makes sense.
Secondly, it's incredibly straightforward to implement. You can buy an index fund or an ETF with just a few clicks.
And thirdly?
Thirdly, and perhaps most significantly,
Okay.
historically, passive investing has actually outperformed active investing over the long run.
Really?
Yeah.
So taking a more hands-off approach could lead to better returns.
That's what the data seems to indicate.
Wow.
Now, past performance doesn't guarantee future results.
Right.
But the evidence is pretty persuasive. Remember that statistic we mentioned earlier about the majority of actively managed funds failing to beat their benchmarks?
Yeah.
So it's a strong argument in favor of passive investing.
Yeah. It's definitely giving me some food for thought.
Good.
So it sounds like sticking with those simple low-cost index funds.
Yeah.
Seems like a pretty solid strategy.
If your goal is to kind of align your returns with the market's overall performance and keep costs low, then passive investing is a great option.
Okay.
But of course, there's always a but, isn't there?
There always seems to be a but lurking in the shadows.
The reality is that some people genuinely enjoy the challenge and the intellectual stimulation of active investing.
Right.
Even if it doesn't always translate to higher returns.
Yeah.
And that's perfectly fine. Investing should be something that resonates with you.
Makes sense.
And if you find the process of researching those companies and making those investment decisions rewarding,
Yeah.
then by all means, pursue it.
It's about kind of finding what matches your personality,
Exactly.
your goals,
Yeah.
your comfort level.
Absolutely.
But regardless of which path we choose,
Right.
the insights that we've gotten from this deep dive
Yeah.
can help us make more informed decisions along the way.
Absolutely. Whether you decide to actively pick stocks or go the passive route, with index funds having a solid understanding of these fundamental concepts.
Right.
Stock valuation, market efficiency, the forces that drive those stock price movements.
Yeah.
It can all make you a more knowledgeable and confident investor.
Well, we've reached the end of our deep dive
We have.
into this really fascinating world of stocks and the stock market.
Yeah, it's been quite a journey.
It's been a whirlwind of information.
It has.
And I feel like I've learned so much.
Good.
We've explored everything from those first steps with IPOs
Right.
to these really complex valuation methods,
Yeah.
market efficiency,
Yeah.
and even pondered those big questions like, can anybody really predict the future
Right. Is it even possible?
in this very dynamic landscape?
Yeah, we've hopefully demystified some of that financial jargon,
For sure.
challenged some common assumptions, and provided a solid framework for you to think about investing in a more informed way.
A huge thank you to our expert guide for walking us through this really intricate world.
My pleasure.
And to our listeners, keep those curious minds engaged. Keep asking those insightful questions.
Yes.
And remember that learning about investing is an ongoing adventure.
It is. As we wrap up this deep dive, just remember that there's always something new to discover in the world of finance.
Yeah.
So if this episode sparked your curiosity, don't stop here. Keep exploring, keep questioning, and remember, even the most seasoned investors are constantly learning and adapting to this ever-evolving market.
Right.
Until next time, happy investing.
See you next time.